Hello everybody. In this moment we are talking about stock market. The stock market is a constellation of marketplace where securities like stocks and bonds are bought and sold. Stock markets provide you with easy, transparent access to investment assets, and they help professional investors determine fair prices for public companies. Think of the stock market as the main financial venue where investing happens. It's collection of all the places where matches are made between buyers and sellers trading shares of public companies. The stock market can refer to the entire world of securities trading, including stock exchanges where the shares of public companies are listed for sale and markets where other securities are traded. The stock market helps companies raise money to fund operations by selling shares of the stock, and it creates and sustains wealth for individual investors. Companies raise money on the stock market by selling ownership stakes to investors. These equities stakes are known as shares of stock. By listing shares for sale on the stock exchanges that make up the stock market, companies get access to the capital they need to operate and expand their businesses without having to take on debt. In exchange for the privilege of selling stock to the public, companies are required to disclose information and give shareholders a say in how their businesses are run. The performances of individual stocks vary widely over time, but taken as a whole, the stock market has historically rewarded investors with average annual returns of around 10%, and it is making it one of the most reliable ways of growing your money. And then, how does the stock market work? The stock market is a vast, complex network of trading activities where shares of companies are bought and sold, protected by laws against fraud and other unfair trading practices. It plays a crucial role in modern economies by enabling money to move between investors and companies. Sometimes the best way to see how something works is to look at its parts. The point of the stock market is to provide a place where anyone can buy and sell fractional ownership in a publicly traded company. If and it distributes control of some of the world's largest companies among hundreds of millions of individuals investors, it is very, very interesting for investment. And the buying and selling decisions of those investors determine the value of those companies. The market lets buyers and sellers negotiate prices. This negotiation process maximizes fairness for both parties by providing both the highest possible selling price and the lowest possible buying price at a given time. Each exchange trades the supply and demand of stock listed there. Supply and demand have determined the price for each security or the levels at which stock market participant. This process is called price discovery, and it is fundamental to how the market works. Price discovery plays an important role in determining how new information affects the value of company. Investors benefit by exchanging their money for shares on the stock market. As companies put that money to work growing and expanding their businesses, investors reap the benefits as their shares of stock become more valuable over time, leading to capital gains. In addition, companies pay dividends to their shareholders as their profits grow. And then, how are prices determined on the stock market? Stock prices on exchanges are governed by supply and demand, plain and simple. At any given time, there's a maximum price someone is willing to pay for a certain stock, known as the bid price. There's also a minimum price someone else is willing to set for the shares of stock, known as the ask price. Think of stock market trading like an auction. Buyers are constantly bidding for the stocks that other investors are willing to sell. If there is a lot of demand for a stock, investors will buy shares quicker than sellers want to get rid of them. This can move the price higher. On the other hand, if more investors are selling a stock than buying, the market price will drop. There are plenty of catalysts that can push the market up or down. For example, in the recent stock market downturn, big reasons for the market's poor performance included inflation pressures, supply chain issues, rising interest rates, and recession fears. These factors resulted in more investors selling stock than buying, which is why we saw stock prices generally decline. Taking it a step further, it is important to consider how it's almost always possible to buy or sell a stock you own. That's where market makers come in. I think it is enough for this session, and thanks for watching. Don't forget, give this channel with your like, comment, share, and subscribe. Thank you.